Okay, but for the budget, for the nation as a whole, for our economy, the one thing you wouldn't want to give is the employment market. Now, the government in the budget has got unemployment forecast at 4.25% going out. If there is an economic shock that takes place, it could lead to that unemployment rate being much, much higher. And if that's the case, then quite clearly it costs the budget an awful lot and costs Australia's economy even more.
Absolutely. So the RBA will be watching that very, very carefully in terms of how they set policy. They've got a dual mandate. They set their mandates based on the outlook for inflation and the unemployment rate and the labour market. I think that, the way I see this is if the global economy is going into a bigger downturn and the downside risks play out, that's typically disinflationary. It typically puts downward pressure on inflation. And the other element, of course, is if there's going to be trade diversion. If China and the Asian economies are less able to export their manufactured goods to the US economy, as these tariffs would imply, then there's going to be more of those sorts of products coming into our market and to other markets. And that may very well actually mean that you get more downward pressure on inflation. That will leave the RBA more of an open door to be able to lower interest rates faster. So I think I think those are the sort of protective mechanisms we're looking out for. And I think Australia is still in better shape than most.
I'll tell you what's interesting. So 4 rate cuts this year. As I say, the market's also pricing in a very high probability of that taking place. Paul Bloxham from HSBC, many thanks for your time.
Thank you.